As a startup CFO, you know how to differentiate angels from venture capital, and you know that venture capital is formal investment companies. But also within these formal investment companies, there are different companies, so to say. And there are the pure investment companies like Sequoia or Greylock. And there are corporate investment companies, companies that are associated to big corporations and actually in most cases invest the money from the big corporations in their strategic way. And then there are publicly funded investment companies and incubators who are also formal and can invest money. However, I like to focus on A and B right now in order to understand them a little more. So first of all, we have the pure investment companies. They are only driven by financial goals, so they want to make money. The corporate investors, on the other hand, they are also driven by financial goals, but they also have strategic goals, so they might think about sacrificing their financial goals to realize a higher strategic goal. All of these companies, both if it's a VC or a corporate VC, they basically have the same organization in most cases. And let's look at the pure investment company to understand that. So a pure investment company, a venture capitalist like Greylock, Excel, and so on, they first of all have a management company. This is where it all starts. And this management company, what they say, we'd like to raise a fund. So they go into the market and they look for investors to raise their own fund. And it could be a very specific fund for investments in the IT or medicine technology or whatever sector in a certain stage and so on. And also management companies might not only have one fund, but they might have 2, 3, 4, 5 funds. Actually, they put one after the other. So what they do is they go to potential investors and say, okay, I'd like to raise a fund. Please put your money into my venture capital fund. And then they get so-called capital commitments for the venture capital funds. The investor doesn't literally put the money in at the first day, but he gives a capital commitment for X amount of money. And the management company now takes the money and invests it into the portfolio companies. And after an amount of time, they try to exit those portfolio companies by selling that, for example, to financial investors or industrial companies. So in general, that's exiting over here. And the money flows back into the venture capital fund. And then if the venture capital fund is earned back plus a 5, 3, 7, whatever percent, the profits are divided in 80% here and 20% into the management company. In addition to that, the management company gets a management fee, in most cases like 1 to 2%. And so if you talk to those VCs, they say it's a 220, means 2% management fee and 20% of the profits. And only the really, really successful ones, for example, can do like 3% management fee, 30% into the management company. However, this is technical things for venture capitalists. More important is the entrepreneur's perspective. And there are 2 important issues to understand for entrepreneurs that play a role. The first important issue, those funds, they are not evergreens. They are raised for, let's say, 8 to 12 years. Might be a little more, might be a little less, depending on the stage or a multi-stage, whatever. And so take the example, you have a venture capital fund who invests into your company and it's running for 8 years. The fund is already 2 years old and they invest into your portfolio company. The one thing is very clear, that after 6 years, finally, the investor has to exit in order to get the money back. That's very important. So you have to know that. That's the one thing. And they will put pressure on your company to realize their exit. Actually, they start with a contract, they put contractual details in, they force you to sell. And after 5-6 years, if this is bad timing, they don't care too much, because the worst thing is you survive and the fund has to be closed and they don't get the money back because it's a write-off for them. So they even love to sell for a lower amount. So that's the one thing to know, the time duration. And by the way, that's different to business angels. Business angels don't have time duration. That's the difference between informal and formal equity. So the second thing is you are one of 10, 20, 30 portfolio companies. That means the venture capital fund plays a portfolio game. And now think about one thing, which is basic economics, the risk-return relationship. The risk-return relationship means the higher the risk, the higher the returns. Venture capital funds would like to realize higher returns. So they have to push the risk accordingly. Meaning they push you to internationalize faster. The only really thing that counts for them is you being a great big exit. And the only way to realize that is push your risk-return relationship, which on the other hand means that you are going a higher bankruptcy risk. And this also what studies say, venture capital-backed companies have a higher bankruptcy risk than non-venture capital-backed companies. It might also be the nature of the companies, but this is also true due to this risk-return relationship. So if you go to raise capital from a VC, you have to know that he'll push you to be a large, important, big company. And it's for him, he only has to have 1 or 2 out of 10. And if 8 go bankrupt, it's not necessarily the worst thing for the VC, but it's not good for you. Remember the divergence of interest. Know that. It also tells you actually in that moment, when do you go to raise money from a VC? Only if you know how to scale up. If you finish your learning processes, then you can go to a VC and get money, because a VC won't give you the time for the learning processes. Angels do that, but VCs don't. VCs love to scale up. So now you have a better understanding for when to raise VC money and how to survive in early days with other people's money. We have a VC MOOC and we're focusing on these questions in the VC MOOC. So I do welcome you there. This is just a general idea to differentiate venture capital from informal equity. Now, these pure investment companies are not the only VCs. There are also corporate VCs. There are a lot of corporate VCs around, like funding from BMW, Intel Capital, Citi Ventures, Google Ventures. You see, there are also others who can obtain venture capital out of a corporate setting. Why do corporates do that? Actually, they also want to make money. So this is the corporate investment company. They have financial goals. But besides financial goals, the most important other issue is they have strategic goals. And if you look into that, you can basically differentiate 4 different strategic goals. The first one is you observe technology. Your CVC, you get an idea what's happening around you. The second is if you buy or if you invest into those companies, you might push your own growth, also by new technologies you buy in, or you might push your efficiency depending on the companies you take in. And the last but not least, what you can also foster is the entrepreneurial spirit. You can promote the entrepreneurial spirit in your company because you give your employees a chance to outcarve businesses and finance them, or you can make your company more entrepreneurial because you have entrepreneurs being associated with you. Is this really working? Well, it's questionable. If you look at that from an empirical standpoint, you see that many CVCs didn't work out too well. We have a new wave of that right now, and we'll see in the future whether it might work out or not. Maybe these companies shouldn't invest into venture capital, but do projects with those startup companies and also realize their strategic goals, because those projects, they are a lot better in doing that compared to venture capital investments. But that's a different kind of discussion. So in general, venture capital investment follow 4 key principles. First of all, it's fairly early still, so there's quite a higher risk-return relationship. Then it's a portfolio game again. There is some strategic exchange relationship with the corporate VCs, and in most cases they only want to have a minority participation. So those corporate VCs normally don't want to buy the entire company. They want to be part of it. They want to see what happens with the new business they have shares in. However, and one last thing, I'm always talking about how important it is to get money on the one hand and get help on the other hand. There's one quote by Vinod Khosla, and I think it's a very interesting one. Since Vinod Khosla was working for Kleiner Perkins as a VC, has his own VC right now, and he says 70 to 80% of VCs add negative value to startups. If it's true or not, I don't know. I don't have the numbers, but the only thing I can imagine from what I said before, if you are a startup CFO and you like to obtain venture capital, you have to know when to get venture capital. And it's only when the timing is right, when you have learned enough and you can scale up. Otherwise, these guys will add negative value because they push you to a different risk-return relationship which you might not be able to handle. That's important for a startup CFO to know.